answer is yes. We were all surprised by the nomination of Mr. Trump as a president. We went directly into a meeting, in the morning, and we decided to take 4 actions. First one, obviously, was to cut our bond exposure. So we had a 30 years bond future in the portfolio. We sell it and we place towards a 5 years bond future. So the idea was really to cut the duration of the portfolio. We also sold our emerging local currency debt exposure. We had a 2.5 in our emerging debt fund, and with the pressure on the US dollar, we had to take into action a sell on that asset class. We also increased our equity exposure slightly in a domestic US equity. We select, in fact, Russell 2000 future, and then we take 1% allocation into that market because of the Trump story, Trump reflation on US domestic growth. And the fourth action was to take some profit on our Asian long-short equity fund, Mandarin, and then we decided to reduce by 1.25% that position. Yes and no. Yes, because we slightly, we cut, as I said, we cut the EM local currency debt. So we cut, in fact, to 0% our emerging currency exposure, but no on the dollar. We kept more or less unchanged our exposure to the US dollar. We were not quick enough. The dollar went up strongly. So we decided to keep more or less unchanged. Actually, the portfolio has 15% allocation toward foreign currency, roughly. But the main of that is towards US dollar, as we cut the emerging. So we only have now US dollar and euro as the main foreign currency into the fund. Yes, we must then a bit make a difference between institutional and retail investors. On institutional, I will maybe tell you a bit about more Swiss investors, Swiss pension fund, because of course I know this market a bit more. For the last 2 or 3 years, pension funds are facing very low yield environments. So they try to diversify a bit more their asset classes and try to focus more on illiquid asset classes. When I mean illiquid asset classes, we saw strong demand on infrastructure, private equity, private loans, world real estate, as well as Swiss real estate, and also recently an increasing demand on absolute return product. And all these demands are from a diversification from the bond side. So pension funds tend to reduce their bond allocation and try to diversify into illiquid asset classes. For the retail side in Europe, we saw, and in fact we were also pleased to see that in Europe a strong demand on the low volatility multi-asset segment. And as you know, we manage also a multi-asset fund, my colleague in Milan, for retail investors in Europe. And then retail investors have strongly demanded a multi-asset fund with a low volatility setup. Really, because they were a little bit skeptical about the equity market, the bond market, how to diversify, what asset class to invest in. That's why we saw a strong demand in that segment. Well, first of all, thank you, thank you to them, because we try to do our best, but for you first, for investors, for our client, and we are absolutely convinced that the Quattro Fund has a bright future. We try to focus mainly on capital preservation when the market is in adverse condition. So this is the first goal, but of course we try to achieve stable return over the medium term. So we have strong experience to manage multi-asset funds. We have access to the full capacity of big data asset management, i.e. to all the expertise of our firm, and that helps us really to construct a really solid, well-diversified portfolio. So thanks for investing in Quattro. Thanks for putting your trust toward our fund. We are doing the best to provide you the best return we can give you. We are focusing on capital preservation. And again, thanks for your confidence and how we will have a long life together. Thanks.